For more on the markets, let's bring in JPMorgan's Asset Management Chief Global Strategist David Kelly here joins us at Post 9 in the wake of the jobs number. Happy Friday, David. Good to have you. We've been talking about a lot of the signs of a cooling labor market, at least after jolts and some of the wage numbers today. What do you make of it?
Well, it's kind of like when you take cookies out of the oven. I mean, they're cooling, but they're cooling so slowly, and that's okay. I mean, this is really very good news. We've got 27 consecutive months now where the unemployment rate has been at or below 4%. That's the longest stretch since the 1960s.
Nixon.
So it's really very good. And one of the weird things that I think is going on here, and we don't talk about the upside of immigration because of the really chaotic way that people are coming into this country, but there were more than 2 million job authorizations handed out by the immigration services in the last fiscal year. That was up from 1.2 million the year before, because all these people who've applied for asylum, they're not going to get a hearing for 5 years, but within 6 months, they're eligible to work. And I think that's beginning to fill some of the gaps that we're seeing, particularly in leisure and hospitality and retail. A lot of those job openings have actually come back down to pre-pandemic levels. We've still got a big issue in healthcare and a big issue in more skilled areas, but we are seeing employment growth, labor force growth coming partly because of immigration.
Right, and that got reflected in some CBO data in the last couple of months.
Absolutely.
Meantime, these productivity numbers keep raising. In fact, there's a desk note out of JPMorgan today that says this is a real discussion point now for clients. The idea that you can let the economy run and still keep unemployment below 4.
Well, that's right, because what we're seeing right now, I mean, if you look at the wage data for January were distorted by weather, period. So look at the numbers from February. 4.3% year-over-year wage growth. It's okay. It's a little on the hot side, but 2% inflation, if you can do 2% productivity and 2% increase in goods prices, that's actually equilibrium. But you can do 4% wage growth and everything stays stable. So we can do good wage growth in this economy and still get to 2% inflation, which is a very good outcome.
So where are you, June, for the first cut, and how many? Because it's still going to be a careful art here.
Oh yeah, I think so. I mean, it's a tricky bit of acrobatics here, but we think the Federal Reserve will cut rates, 25 basis points in June, 25 in September, 25 in December at those SEP meetings where they're giving out more information. They're just going to take it slowly. But long may this last, because of course not only is it good for the economy, but it's also good for investors. This is really what's supporting a continued rally in the stock market, and the fact that wage growth is not exploding is also helping the interest rates from not going higher.
So at this point, what are the expectations around earnings? Given here we came in again and we got surprised on better economic data.
Well, yes, but the earnings are going to be... we are not going to match the analysts' expectations. The analysts are still looking for double digit this year and next year. I think we'll get mid-single digit, but if we have over 4% wage growth and slowing nominal GDP growth, which is what's going on, I think that's going to make it hard to hit those targets. But, profits are at very high levels. I think if we can just do mid-single-digit earnings growth, I think that's really fine. I still think there are parts of the equity market which are overpriced at this point. But people tend to just keep on making bigger and bigger bets further out until you get shocked. And so I think you've got to be careful, because the next shock could really change relative valuations. But for the moment, this is an economy which seems to be supporting a slowly rising stock market.